All right, if you're a mortgage loan originator, you know the regulatory world can feel, well, like a total maze. So today we're handing you the map. We're going to break down the key federal mortgage laws you absolutely have to know, but in a way that's clear, practical, and actually helps you in your day-to-day. Let's jump in. So let's start with the big question, right? Why on earth are there so many rules for just one loan? The answer is pretty simple. A mortgage isn't just any loan. It's one of the biggest, most important financial steps a person will ever take. And with that comes some serious risk. Every single law we're about to talk about was built to tackle a specific risk and to wrap a protective shield around the borrower. Okay, so how are we going to tackle all this? Well, we've organized everything into three core pillars: transparency, fair lending, and what we're calling targeted safeguards. We'll kick off with the big picture, dig into each pillar, and then, and this is the most important part, we'll tie it all back to your role in this whole process. So let's lay the foundation. If you walk away with just one thing today, I want it to be this. Every single rule, every form, every piece of red tape has the exact same goal at its heart: protecting the borrower. And there it is. This is the mission statement. This is the why behind everything else. It's not about making your job harder. It's about making sure the market is fair and clear for everyone trying to buy a home. Keep this in mind as we go. All right, on to our first pillar: transparency and disclosure. I like to think of these as the sunlight laws. Their whole job is to shine a bright light on the process, to give borrowers clear, upfront info so they know exactly what they're getting into. No mystery, no confusion. First up, we've got RESPA. You can just call this the No Surprises at the Closing Table Act. It's all about making sure borrowers see every settlement cost up front. But just as importantly, it completely outlaws kickbacks. That means no more shady deals where someone gets a secret fee just for sending business their way, because that stuff just inflates costs for the consumer. And then there's TILA, the Truth in Lending Act. So if RESPA is about settlement costs, TILA is all about the cost of the money itself. This is the law that gives us the APR, the annual percentage rate. It's the magic number that lets a borrower actually compare different loans apples to apples to see which one is the better deal. Now, for a long, long time, having these two different laws meant borrowers got a pile of different forms. You had RESPA disclosures, you had TILA disclosures. It was, frankly, a mess. Super confusing and just made it hard for people to figure out what was going on. It was obvious something had to change. And that change was TRID. The Consumer Financial Protection Bureau stepped in and basically said, let's fix this. They merged those confusing RESPA and TILA forms into the two documents you live and breathe every day: the loan estimate and the closing disclosure. Honestly, this was a total game changer for borrowers. And to round out this transparency pillar, we have the Homeowners Protection Act. This law is all about making sure people don't pay for private mortgage insurance, PMI, for a single day longer than they have to. It sets up clear rules for when PMI has to be automatically canceled, which is another huge win for cost transparency. Okay, let's move on to our second pillar. And this one is massive. It's the absolute bedrock of ethical lending, ensuring a fair shot for everyone. These laws are designed to create a level playing field, making sure every qualified applicant has the same opportunity to get a loan. The two heavy hitters here are the Equal Credit Opportunity Act, or ECOA, and the Fair Housing Act, the FHA. Think of them as a power duo working together to flat out forbid discrimination in housing and lending. And they do this by defining what we call protected classes. What this means is it is illegal to make any part of a lending decision based on these things. The only thing that should matter, the only thing you can focus on, is the applicant's financial picture and their ability to repay the loan, period. So how do we make sure everybody's actually following these rules? Well, that's where HMDA comes in. Think of HMDA as the accountability engine. It forces lenders to report data on who's applying and who's getting loans. This allows regulators and even the public to look at the data and spot any patterns that might suggest discrimination is happening. It keeps everyone honest. All right, on to our third and final pillar: targeted consumer safeguards. Now, if the first two pillars were about broad principles, this one zooms in. These laws are designed to deal with very specific risks, often protecting borrowers who might be more vulnerable or dealing with higher risk loan types. A perfect example is HOPA. This law is like a special shield for people getting what are called high-cost mortgages, loans with really high interest rates or fees. It triggers extra disclosures, requires counseling, and puts a stop to risky loan features like balloon payments that have been used in predatory lending in the past. And of course, we can't talk about mortgage laws without talking about the big one, the Dodd-Frank Act. This legislation completely reshaped the industry after the 2008 crisis. Now, it's a huge law, but for you as an MLO, you can really boil its impact down to three major things. It created this CFPB, it gave us the all-important ability to repay rule, and it beefed up protections for homeowners after they've closed on the loan. So we have covered a ton of ground. We've talked about the landscape, the three pillars of protection, but now let's bring it all home. What does this all actually mean for you, sitting at your desk, talking to clients? And this is really the key takeaway. You're not just a loan originator. You're the frontline guardian of all these protections we've been talking about. Your knowledge, your ethics, your commitment, that's what turns all this legal jargon into a real, tangible safeguard for your clients. At the end of the day, compliance isn't just about following rules to avoid trouble. It's about building trust. It's about making the dream of home ownership a little bit safer and a little bit fairer for everyone you work with. So the real question I want to leave you with is this. How are you going to take this knowledge and actively champion these protections for your clients, starting with your very next loan?